Welcome to TheoTrade. This is Don Kaufman. It's November 14th, 2018, and you are watching the TheoTrade evening video. Again, another wild ride inside of the broader markets today. Let's get right down to it. I mean, the range inside of the S&P futures today is fairly astounding. We traded all the way roughly from 2750 down to 2686, and I got to tell you, the sell side activity in here was fierce. We just came shy of one of our gravity points, which happened to be none other than 2682. We missed it by, again, 4 handles, and the rally was wicked to the upside. I mean, this is like that quintessential rip your face off rally to the upside, only to be stopped in its tracks, reverse, and see more sell side activity by 25 handles inside of the S&Ps. Again, wild ride would be a bit of an understatement. Let's get right down to it, because this kind of intraday volatility begs the question, what are you going to do in terms of strategy? Because right now, let me tell you something about a marketplace that's moving, okay, in a range that's, north, let's call it, of 50 S&P points in a session. You have to do everything right on a strategy, front. Everything right. Because when it comes to directional bias, you're going to feel like you're doing everything wrong. You get long, the market sells off, You get short, we rally huge. You actually reverse your position, we sell back off. And again, this marketplace is going to be phenomenal at catching you wrong-footed. Hence, in just a moment, we're going to talk about 3 different strategies that, what you want to do in this marketplace, you've got to get it done using, one of these strategies. Before we get too detailed into the strategies, again, we see some more sell-side activity inside of the broader S&P. But what has me a bit more concerned, and again, everybody's got their head once again turned towards Apple. I mean, listen, maybe you should, right? It's the largest market cap, Might not be the largest market cap too soon, but it's the largest market cap, and it fell almost another 3% today. And if you're taking a look at Apple on a year-to-date percentage, from the high to where it currently is, again, we're very rapidly approaching what we would term bear market kind of turf. This was up, as I said, just shy of about 35%, is now only up about 8%. And a lot of people at that point qualify this as, it's a bear market, which is, from high to low, it's roughly about a 20% decline. And when your largest market cap gets close to that, I think you should definitely pay attention, of course, to it. However, when I say they have their head kind of turned in the wrong direction, let's look at the broader markets for just a moment, the S&Ps, and then again, we're going to talk a little bit about strategy. I'm going to turn off some of our expected moves for just a moment. At kind of the peak of the year, the S&Ps were up just about 9%. Now they're roughly flat on the year. So the point being of me actually going through a little bit about Apple, which is, again, getting crushed from this ride of, up almost 35%, now only up 8%, versus the S&Ps, is the S&Ps are still actually hanging in there relatively well, versus a number of major, market caps that are appropriately getting slaughtered in the near term. But that isn't, again, what has my attention. And Corey Rosenblum actually hit upon this a little bit last night, and I've been talking about it extensively. Everything right now pertaining to the S&P. Let's forget about the Nasdaq, because the Nasdaq truly belongs, It belongs to Microsoft. It belongs to Apple and Facebook and Amazon and Google. When I say it belongs, I mean, listen, what those stocks do will determine the future of the Nasdaq. But the S&P, the broader S&P, is much more substantial to move. And for the S&Ps to move, you need the financials to be under pressure. And that is precisely what we have seen, in the last couple of trading sessions. First of all, the financials are now down on the year over 5%. Wild sell-side activity, though. And again, this is actually what caused most of the bounce back up and the fade. Now, for those of you that have been tuning in week in, week out, day in and day out, I've talked extensively, almost for a point ad nauseum, again, of a level specifically inside of the financials, and this is kind of our, our Maginot line, if you will. It's 2650. We're under it. Anything under 2650, the entire S&P is in very, very serious territory. So you have to watch this extraordinarily careful because we're only under it, again, by a negligible amount, to the point where, listen, we're pretty much sitting on, our market Maginot line. Coming under 2650, though, will be devastating to the S&P futures, and it'll actually open up. It's, for the most part, it's going to crack the S&Ps wide open if we stay under 2650 inside of the financials. That doesn't just open the door to 26. It actually opens the door to see sell-side activity in the S&Ps even progress lower than, of course, 2575. So we obviously are going to be keeping a very, very close eye on that. Another aspect also related to the financials has to deal with, of course, Goldman Sachs. So for those of you that don't necessarily tune into individual financial companies, Goldman Sachs is officially today, all right, we're a bear. What does that mean? Well, it's down now, again, to the tune of over 20% on a year-to-date basis. So we start to look around at a few of the other financials, and this is where, again, I happen to carry a fairly substantial short position inside of JP Morgan. JP Morgan is still flat on the year. And this is something I'm going to be talking about in just a moment when it comes to strategies, okay? In strategizing this marketplace, I want to be, okay, in JP Morgan, and I want to be short, because if you start to look around at a few of the other financials, listen, Morgan Stanley getting decimated, Goldman Sachs getting decimated, okay? Even if you look at Bank of America, underwater by almost 9%. JP Morgan is still outperforming, and it's only a matter of time. You hear me say this a lot. It's only a matter of time before the algorithms start to actually turn and fire into what has been one of the stronger areas in a particular sector. It has nothing to do with the fundamentals of JP Morgan and everything to do. It's in a sector that's under duress. And when a sector is under duress, they're going to hit everything. Okay. Next point. Let's go take a look at Macys. Why am I looking at Macys? Because this is a position that we've talked about extensively on these evening videos and within the chat room on a day-to-day basis. I'll update you guys on Macys. Macys had earnings. The earnings were good, and they guided higher. When I say the earnings are good, the estimate was just 17 cents. The actual was 27 cents. They smoked their numbers, and the street absolutely crushed them. Why? Well, everybody forgot about Macys until their earnings came back out. When the earnings came out, well, how could we possibly want to be in this? They hit it to the tune of 7%. And again, there's more to come on the retail front. If you're into retail, you should start watching the XRT very, very carefully. The XRT took another hit today and looks like it's about to form a leg lower. However, tomorrow morning, we're actually going to have earnings from the likes of Walmart. Here is going to be setting the tone for the entire Christmas season. Got to watch Walmart a bit after the cash open tomorrow, because if Walmart were to project that their sales might not necessarily be anything less than spectacular, will be totally uncivilized sell-side activity in Walmart. This is an underlying, okay? This is an underlying that just rallied, okay? A massive percentage. I mean, again, this thing is not, the latest, greatest tech company. It's Walmart, people, and they better come up with a spectacular guidance for the holiday season, or retail itself is going to be in dire straits. Last thing before we actually talk a little bit about strategy, Boeing. Boeing, it's still the linchpin inside of the Dow. It's up 16%. It's really been fading hard and showing extraordinary volatility in the last 3 trading sessions. Look for Boeing actually have continued sell-side activity. However, in the very near term, I want to make this very clear, that in the near term, there isn't any bias per se on a day-to-day basis. Tomorrow, the market could be wildly fickle. We could rally 50 handles in the S&P followed by a sell-off. For those of you, okay, when it comes down to strategy, in an evening video, we don't have time to describe every strategy into detail. Most of these strategies we spent 3 and 4 hours doing classes on. However, when it comes down to it, when you're talking about strategy, there's a few things you want to be involved in. Number one, selling options premium. Lots of people are going to try to sell options premium. Right now, I would not sell options premium in an index product. So I want to make sure that you get your strategy right depending upon products. I would not sell options premium inside of an index product. Why? And for those of you that speak a little bit of geek, it's because the HV, which is the historical volatility, the historical volatility in most cases is outpacing the implied volatility. So the option market this week priced in about a $50 move higher or lower. Yeah, guess what? Got over a $50 move today, right? So actual is what? Over implied, which does not make for good selling, specifically in the index products. If you're going to sell options premium, then you got to cruise over to stuff like Amazon. Okay, why? Because Amazon's actually got its volatility. It's got its backup. It's a 80% implied volatility rank, or what we term percentile in this particular case. We sold Amazon Premium. We sold a call spread in here, multiple call spreads. We actually covered them for near full profitability. So out and done. But if you're going to sell premium, stick to the equity products. Stay away from index products. If you want to take risk inside of the index products, again, the SPX, the spiders, or index-related spiders, or XLF, you got to use InOut Spreads. For those of you that do not know what InOut Spreads are, the InOut Spread is going to go out. You're going to buy one option in the money, sell one option out of the money. For the most part, the InOut Spread looks something along the lines, okay? This is actually the purchase of put, which is the 70.5 put, and I would turn around, maybe sell the 60.5 put against it. This is a $2 wide spread for about an 80-cent debit. It's one strike in the money, one strike out of the money. Why do I do this? I do this to mitigate volatility risk. You see, the problem is when the markets start getting a little bit more volatile, okay, what people do not think about, they go out there and they go, I'm going to buy me a call. Yeah, go ahead. You want to go buy a call? Okay, even in the really, really short duration. You buy a call in the midst of this volatility, you're dead. Dead the second that it rallies. Look at this. Look at what we term the Vega exposure. Vega is the sensitivity to changes in implied volatility. You know, this is an option that normally has 2 days left. Okay, it doesn't matter whether you're 2 days, whether you're 10 days, whether you're 50 days. Look, there's 23% IV. The second we rally, okay, what's a rally? It's when the market goes up. If the market goes up, where's implied volatility going to go? Down. How down? Well, they're going to crush this thing. I don't know. Let's take it down, to 15. So the IV goes from what? 23, 24 down to 15. So let's just say that there's 7, 8 volatility points. We'll call it 8 volatility points. So subtract, 8 vol points. That's 8 times 10. Okay, you just lost what? About 80, 90 cents just for being you. It's 50% of the premium of the option, is nothing more than that IV. So IV is pumped up. You buy a call in this, dead. So what do you have to do? You have to use these in-out spreads, because what does an in-out spread do? What does it do? By buying an option, again, that's in the money and selling an option, for example, that is out of the money, you're offsetting your volatility risk, right? Because with one hand, we're buying the volatility. With the other hand, we're selling the volatility. So it mitigates volatility risk. It is absolutely critical that we understand in-out spreads to survive directional bias in this marketplace. So we talked about selling premium. If you're going to sell stuff, don't do it in the spiders, Spiders aren't ready, right? Maybe the spiders, listen, they're cooking, but they're not ready yet. So I would not be selling premium out in the index products. I would still be using in-out spreads if I want to get directional. If I'm going to be selling premium, it's going to be in some of the monsters of tech probably that are getting absolutely whacked. Specifically, if you want to look for a selling premium, Apple's starting to get up there, Amazon's starting to get up there. You got to feel the pain, right? Then it's time to sell some premium. Now, by the way, that's also should tip you off that some of these equities are getting hit hard and their IVs are up, right? But the index products aren't getting hit that hard. So what? Their IV isn't that high, which tells you there could be a lot more to come. Last but not least, duration positions. Duration positions is where this year, 2018, we have absolutely cleaned house when it comes to duration positions. This is where I go out, in specific underlyings, like, for example, Caterpillar. And we take a look at Caterpillar, and I've had this position on since the beginning of the year. When I say duration positions, I've been buying deep in the money puts and rolling them out. There was one I just put on recently inside of Microsoft, where we're actually purchasing deep in the money puts. And the purchase of these deep in the money puts is a synthetic short stock position. These are, when I say duration, I intend to hold these things for 3 months, for 4 months, maybe for a year. Why? Because there's a whole lot of room in this marketplace for downside improvement. One thing again, when it comes to this type of volatility, on an intraday basis, do not get caught up in it. Okay? Again, volatility is always going to catch you wrong footed. You're always going to feel like every step you take is going to be the wrong step. Get into the correct strategy, a comfortable allocation, okay, and you will be fine. But you have to put on an allocation that's going to allow you to weather that storm. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.